Good afternoon. This is John VanWeelden with VanWeelden Financial Group and The Real Deal on Retirement. And what I want to do today is take a moment to do a very, very brief overview of the year that was 2022 in the financial markets, specifically for our clients that don't have annual reviews that happen, in the winter months. It's come to our attention that a whole lot of people don't really understand or are unaware of what really transpired in the broad markets in 2022. And it was pretty significant. In fact, practically unprecedented in our investing lifetime. So I thought it might be helpful to send out a quick video, a 30,000-foot overview of kind of what that looked like. So let's go ahead and do a 2022 mini market recap. Well, the first thing I wanted to do is bring to everyone's attention that, we're so used to stock markets being volatile up and down and sideways. We had COVID, we had 2008, we had late 2018. It seems like every other year for the last 5 years or so, the market has tanked at some point during the year. So most people have, for better or worse, I guess, kind of gotten used to that. But what we're not used to, or what most people aren't used to, is the bond market doing that. And in 2022, as you can see by this slide, 2022 was the worst year for 10-year U.S. Treasury notes since 1788. And no, that's not a typo. That's an actual, 250 years. So to say that it was a bad year for Treasuries is an understatement. Now, why does that matter? It matters because 99% of all investment advisors and money managers out there use something called modern portfolio theory as their main investment philosophy, and it relies to a very great extent on the fact that bonds, generally speaking, over the long term, have acted as shock absorbers for stocks. So a lot of you, when you were building your retirement portfolios, we talked about traditional investment philosophy, saying, hey, how much am I going to have in stock and how much am I going to have in bond? And we're going to stick to that through thick and thin. But as you all know, we don't follow that philosophy. We don't believe that it's in the best interest of those of you who are retired or retiring soon. So we like to stay very, very flexible in our ability to move not only back and forth between stocks and bonds, but to divest in either or both of them altogether. And in a year like 2022, it was critical because, as you can see, the U.S. bond market surprised a lot of people because we've been used to the bond, because interest rates have been going down for the last 40, 45 years, most of our investing lifetimes. We're used to bonds being a relatively stable and resilient investment, and in fact playing that shock absorber to our stocks. But last year, tremendous amounts of money was lost in the bond market as the Fed started to hike interest rates aggressively. You can see some other Wall Street Journal article here talking about the fact that stocks and bonds were falling at rates unseen in decades. And this is one of my favorite slides that kind of gives you perspective here. So 2022, if you look at the combined losses of the broad stock market and the broad bond market, 2022 was the worst year combined since back in the 60s. And prior to that, you had to go back to the Great Depression to see a year that it was as bad. And again, most people aren't as aware of that because most people don't follow bond markets. So when you hear the stock market had a bad year, no big surprise. But when you realize that the main shock absorber for the vast majority of people's portfolios also had a really bad year, and that bonds were down double digits as well, it paints a whole new picture. And in fact, we've been warning people for years that although bonds have historically been kind of a risk mitigation strategy, and asset allocation and diversification seems to have done the trick, there was a time coming, and we're in it, quite frankly, in which that type of approach will not be adequate. It is not going to provide the kind of risk mitigation that people believe it has. And in fact, if you look at, there's a fair number of people, older people in particular, who've been retired for some time and who have been able to maintain a highly fixed income portfolio, and rates have been high enough and bonds have been stable enough that maybe they've been able to live off that. But again, that time is changing. And so what do? Do you move back into stocks, which we already know are going to be volatile? So again, just to give you some perspective, quite an unusual year last year. Stocks and bonds both down significantly, and more so than they have been since the 60s. And so again, happy to report that from a defensively tactical positioning, our managers were able to mitigate anywhere from a third to a half of that downside volatility. So we're very pleased with that. At the same time, it doesn't portend very well for the future as we look at stock and bond markets in unprecedented territory, again, at least for our investing lifetime. So the good news is we're on top of it. We are responding to market volatility as we always have. We're mitigating those risks because in retirement, as you know, you just can't afford a major negative year. You can't afford a 15, 20, 25% hit on a retirement portfolio, especially if you're going to be taking income now or in the near future. So to give you perspective, hopefully that helps those of you who haven't maybe been paying as close attention to understand the times we're in. Our strategies are responding favorably to it, but if you can expect to hear more about interest rates and volatility and damage to the bond markets. And in fact, it's one of the reasons we believe the Federal Reserve can't continue to raise rates aggressively. They're stuck between a rock and a hard place. If they don't raise rates, inflation's going to get out of hand. And if they do raise rates, they're going to continue to damage all those folks that are saving and borrowing money and fueling the bond market. And quite frankly, they're going to make the interest payments that our government has to make every year unsustainable. Because again, as those interest rates raise, their required payments raise, and we're already pushing the envelope there. We've been pushing that for a couple decades now. So we'll keep you informed. Obviously, those of you who've already had a review this year, you've heard this, but we just wanted to, again, give an overview for those of you who may not be coming in as soon. And for those of you who aren't working with us, give you some perspective as to why we continue to believe our defensively tactical approach is the best approach if you are in retirement or approaching retirement. So again, I want to thank you for joining us. This has been John VanWeelden with VanWeelden Financial Group and The Real Deal on Retirement. Have a great 2023. Thank you.